The globe has slowed, so it's not only us being affected, of course. Well, my colleague Nompu live at the JSC with EY, I believe. Over to you, Nompu.
Thanks very much, Francis. Yes, well, I'm joined by Andrew Bates. He's the Financial Services Leader for Africa at EY. Thank you so much for joining us, sir.
Thank you.
So, what do you think assisted the index rising from 50 to 58 in the second quarter, given the fact that the economic situation is not exactly conducive?
Yeah, you're right. And it's surprising at one level that confidence has gone up. If you look at the retail banking confidence that we measure, that went from 46 up to 55. And then on the investment banking side from 53 to 61. So whilst the trend is fairly positive, the important thing, as you said in the introduction there, is that that's quite well below the long-term trends that we've seen. The retail confidence has typically been about 67 as a long-term average, and the investment bankers, who tend to be a bit more confident than their retail counterparts in any case, has often been up in the 80s. So what we've seen is a slow uptick in the quarter that we've just measured, which is Q2 of 2016, but still well below the long-term trend.
When you compare the services to the corporate sector vis-a-vis, say, the household sector, which sector is doing better than the other, or are they pretty much the same?
No, retail held up rather better, we think, in Q2. The thing that we survey the banking executives about, apart from confidence, is their expectation of what their results will be for the quarter. So on the retail side, if you look at income and you look at overall revenue for the banks, then it was kind of steady as far as the banking executives who we surveyed are concerned. On the investment banking side, we're expecting that the confidence will really have a knock on the results, because apart from treasury and specialised finance, other areas of investment banking like private equity, like stockbroking, corporate finance, project finance, all showing expectations of declines in income and profitability. So we think on the retail side things have held up rather better through Q2, but possibly some rather worse news to come on the investment banking side.
I'd just like you to do a bit of crystal ball stuff. We know that the Brexit decision took place, and we know that the financial services sector, particularly in the UK, is vulnerable. To what extent do you think that could have ripple effects in terms of the South African banking system?
Well, if you try to reconcile the increase in confidence with what we're expecting, which is slightly depressed results, particularly on the investment banking side, I think what we're seeing is a general level of confidence that the medium-term prospects for banking in South Africa are pretty good. So obviously at the beginning of June we avoided a ratings downgrade. I think that will have had some impact on confidence. We actually ran the data before Brexit, so we were somewhere in between the Standard & Poor's decision and Brexit when we collated the data. So I'm conscious that there might be an impact in Q3. I think the reality of Brexit is that it's dampening growth across the globe. That's the expectation, is that growth numbers will be lower than they would have been otherwise. But in terms of the South African environment, I think the key thing is really the local growth, because the macroeconomic situation here, obviously a function of many different things, but the banking sector will be impacted by what's going on in every other sector. And I think when you look at the IMF report that came out in the last couple of days showing expected very low, near zero growth for South Africa in the coming year, that is the thing that should be of most concern to the banks, is how to get the local economy stimulated such that there is more demand for lending, there is more investment into South Africa, and obviously bringing more people into employment, bringing more people into the market for banking services. That will be the key to growth in South Africa.
I don't want to dwell on the doom and the gloom, but obviously, like you said, we did avert a junk status rating in June, but December is on the horizon. And if we don't get our ducks in a row and we do get a junk status rating, what does that mean? What are the implications for the banking system and ultimately for the consumer? So
the real implication, if that downgrade does come in December, is that it'll cost more for banks to borrow money. Again, in the introduction, you talked about where interest rates have been and an expectation maybe of a rate hike later in the year. It will be more difficult for the banks to raise money, and of course that will be passed on to consumers. So in the end, if you're in an environment where people are struggling to repay on loans, that will only make it more difficult if those are at variable rates. And of course that will also give the banks pause for thought in terms of new lending, because new lending will become more risky if interest rates are higher, because that impacts on the individual individual's ability to repay. So I think what you want is a healthy balance between an economy which is moving quickly and banks which feel able to lend amounts and at rates which are affordable, but at the same time you don't want to choke that off. So I think the implication would be probably in the short term higher level of defaults and also the banks restricting the lending. So that obviously has an impact on the broader growth of the economy.
Sounds like the banking sector will have to brace itself. Thank you very much for your time.
Thank you.
That was Andrew Bates. He's a financial services leader for Africa for EY. After the break, Francis will have more business news for you.